Well, joining us now to break it all down in studio, we want to bring in Steve Sosnick. He's a chief strategist at Interactive Brokers. We also have Greg Daco. He's a chief economist at EY. Great to have both of you. Steve, you're sitting right to the right of me. And I heard you say, wow, under your breath when these numbers came out. How are you looking at this print?
Wow, is my first reactions. In my case, the reaction that fits here. I mean, the numbers. No one was really looking for a rise in payroll. It was just going to be how much smaller was it going to be than last month, and we blew it out. Looking at the 3-month revisions, it's 8,000, which means there's no funny business, at least in the very short term, going on here. The problem here now is if you were looking for rate cuts based on a weakening labor market, this fits in with the Fed rhetoric that we've heard. Stop looking for those. It's not going to happen, at least in the immediate term. And I think, unfortunately for stocks, the bond market doesn't like that. In theory, stocks should like a stronger economy. But in reality, what we're getting is an economy that seems to be keeping jobs in there. And I think, there was the hope that labor was going to get the Fed onto a more accommodative footing. And this doesn't do that right now.
Yeah, Greg, want to get your read in, especially as you're thinking about what this does signal for the Fed and how they could continue to look at this report, even going into the kickoff of their meetings for 2025.
I think it's the paradox of 2025. It's a robust but frozen labor market, one in which we're not seeing much churn in terms of the labor force. We're seeing very little entry into the labor market. We're seeing very little exit out of the labor force. And that is really the state of the labor market right now. It's reflective of businesses being very cautious as to their hiring needs. They're not hiring. The hiring rate is at a 10-year low. They're not laying off either. So you're seeing this steady but slightly cooling labor market trend, which is very encouraging from a Fed perspective. I think the attention will actually pivot back towards inflation developments over the course of the next 3 months, and I wouldn't be surprised that we see some positive inflation surprise with inflation moving lower over the first 3 months of the year on base effects, which could lead to a reassessment of the Fed trajectory by very reactive policymakers.
So what do you think that Fed trajectory looks like then?
I think they skipped the January rate cut, but they still proceed with a March rate cut. The trajectory after that will be highly dependent on policies that are put in place by the incoming administration, whether it's deregulation, immigration restrictions, trade, and tax cuts. All of those elements will influence the economy to a great degree, both inflation and the labor market, and that will lead Fed policymakers, whether they like it or not, to react to those policies.
What's the trade that investors that are firing up their laptops, their computers to a report like this morning should be making?
I think you go back. I think you start to look again at economically sensitive stocks because the economy in general is telling it you're pretty good. I do think you have to watch out for the bond market here. There's a very worrisome signs, and we were supposed to go to hell in a handbasket if we went through 450. That didn't happen, fortunately. Then it was 470. Well, we're through that now for basically 4 3/4. Now they've moved the number to 5, where we should be getting worried. But I do think this is a fundamental issue here. Is we are getting stocks are getting some competition from rates. So I think being nimble and focusing more on economically sensitive names is the way to go here.
Do you think we're going to be reaching that 5% level likely in the next couple of weeks?
The bond market tends to move in big, long trends, like sort of 3 to 4 month trends. I hope not, but after a number like today's, it's hard not to say that we won't see a 5 handle on the 10-year. It's just the momentum is going in the wrong way. It's going in the wrong way internationally. UK and some other places, with the exception of China, where bond rates are basically approaching zero because their economy, is doing the opposite. I think in general, bonds have these. I'm not going to call them secular trends, but sort of if you look back at the charts, they move in a big direction for 3 to 4 months. I don't see anything right now. But this number would have been the thing to break the momentum, and it hasn't.
How problematic, though, is that for equities over time?
The relationship between equities and bonds is a weird one, because if bond rates are going up because the economy is very strong, it's okay. Right, because that means that companies are making money, and that's really what it comes down to as an investor. Am I investing in companies that will bring me earnings, dividends, cash flows, et cetera? That's a good thing. if the bond market, if the bond rates are rising because of inflation fears, because of just general concerns, because of just general malaise, that ultimately does weigh on stocks. And so there is a number at which high bond yields become a problem for stocks, but it's a fluid situation, and it can be very dependent upon market psychology. I think back to when I started in the business, and I'm going to age myself here, and I started in 1987, which was one of the worst years in the bond market, and was one of the best years in the stock market until, of course, it wasn't. But that's kind of that relationship is always stuck in my mind, is that you can diverge for long periods of time, but a lot of it has to do with why. And
you know, you'd mentioned that a lot of the focus might shift back towards inflation, and we have an incoming president that's talked a lot about what geopolitical policies, what tariffs could be added on, and what executive orders are starting to line up for day one. And even within the first seemingly 180-ish days of the presidency, we could see some tariffs get talked about, get implemented. How inflationary do you think that would be, and how much pressure do you think that would put on the wage growth picture as well here to continue to try and outpace some of that anticipated inflation?
I think what Steve mentioned is very important. We have to understand why the yields are rising, because we've had the Fed cut rates by 100 basis points, and yet yields have risen by about 100 basis points. So you've had massive divergence there. And I think there are a few factors that are driving this rise in yields. You have expectations of higher inflation with the policies that are likely to be implemented. Whether it's deregulation, immigration restrictions, trade and tax cuts, they are likely to be inflationary and push up the inflation premium in terms of bond yields. The other thing that we have to keep in mind is that they're also likely to lead to larger budget deficits. Going over the next 10 years, we're likely to be in an environment where the budget deficit is averaging around 6.5% of GDP for a decade. That's the type of budget deficit that you usually have in bad times. So we have fiscal sustainability concerns at the same time, and a risk premium that's being added onto yields. That is why I'm a little bit concerned, because the higher we go with yields, the more of a risk-off environment you risk entering in, which would have a feedback effect on private sector activity and lead to a slowdown in economic activity.